Hey guys, we are covering Score Media and Gaming in this video. So this is a stock that I've covered before. I went over the company's valuation, financials, and just why it wasn't doing so hot in the last few months. So if you haven't checked it out, you should definitely do so. I also covered DraftKings and Penn National Gaming in that video, so it'll get you all caught up on what you need to know. So exciting times for gambling investors. There's some very important news that just came out recently, and it looks like legalized online gambling in Canada is just around the corner. And for those of you who don't know, Bill C-218, the Safe and Regulated Sports Betting Act, that talk started out in November of last year, made it through all the committee hearings and is headed to the Senate for final discussion. And so it looks like the Score will be able to launch their gaming app by the end of the year. And so we will do a deep dive and see what that will mean for the company. First, we will take a look at market share. We have the iGaming platforms where the Score is looking to operate, the total addressable market in billions, and the percentage that the company wants to capture. There are two different scenarios, base case and conservative. For base case, if we assume they take 20% market share in Ontario and the rest of Canada and just 2% in the US, we have approximately $1.4 billion in revenue from iGaming. And if we drop their dominance in Canada by 5% to 15% total, we would then get $1.17 billion. Now with the Score's dominance in Canada, it's not as difficult to approximate here, but the US, I feel, will be the biggest X factor for this company with a total addressable market of around $25 billion. This could very well grow to be more, especially since this industry is still in the very early stages. Here I have some numbers from Credit Suisse and what they have reported for the Score in terms of their market penetration in the US. They believe their media app will capture 12% of adults with media apps in Canada, and that 60% of adults in Canada are sports fans, so this could grow potentially. In terms of market penetration in individual states, they have the Score actually growing in the states that they are operating in. Indiana, in the average of their last 3 months, went from 1.2% to 1.5%, and Iowa from 1.1% to 1.4%. They also provided some numbers on media app penetration for some additional states, all that 6%, which if even a fraction of them use the Score app and bet, with additional market entries, this is a very good sign for the company. Next, I have some numbers to show you just to get a better idea of how the Score is doing in the US. But before I do have to give some credit to Don D, also known as Mr. Hamilton on StockTwits. This was a spreadsheet that he created and let me use to share with you all, so I could not have done this without him. And so the 4 states that the Score is currently operating in, on these 2 rows, we get the total handle of the states, and then casinos, then the Scores handle. And everything highlighted are estimates, and under the state of Indiana, we actually have some real numbers. The US market is definitely competitive. It doesn't look like the Score is contributing a whole lot in some of these months, but the key is the growth in market share at lower costs than competitors. And with more states opening, the type of growth this company will see won't stop. So when we look at the total handle claimed in these active states, the numbers are growing each month from September to December of last year. So looking at the numbers for this year, it doesn't look like the Score's gross handle actually grew too much since December. And looking at individual states this time, New Jersey looks like it's been fluctuating, but still on average it looks higher overall. Now with Colorado, they are posting good growth in this state, but I'd like to see gross receipts go up in the future. Now Indiana has shown quite a bit of improvement. We were initially seeing less than 100K in gross receipts in the quarter before, so this is a huge improvement for sure. And last, we have Iowa, some growth and leveling off like we've seen with some of the other states, so pretty decent stuff. I think it's hard to base the company's performance just on these numbers alone, only because there are so many catalysts being worked on right now. The company is only operating in 4 states now, and John, the CEO, has mentioned that they are looking to get that number in the double digits by the end of next year. So updated revenue projections for the company, everything we see will be from 2021 to 23, and it'll be based on guidance from Credit Suisse and A Capital. In 2021, we will have 31.1 million in revenue, and this jumps almost 10 times to 307 million the next year and 555 in the year after. And then on an EBIT basis, the company will be profitable by the end of the next fiscal year, and this is very important as they will need the cash flows to continue to expand and compete with some of the larger players. And this all to me looks quite promising. Judging by the total addressable market earlier and the revenue projections here, this company was heavily reliant on the opening of Canada, and I'm sure most knew it was only a matter of time that this was going to happen when they bought into the score. Moving on to share price projections, I used revenue multiples of 3 to 7.5 times, and with this model, we have the company projected at a price target of $30.79 to $51.32 in the next 12 months, and $47 to $58.8 the next year after that. Now, the reason why we see these revenue multiples move up like a staircase in these highlighted cells is because these super high growth rates that we're seeing will not be sustainable in the longer term. Especially when the company starts to show maturity years down the line, we won't be seeing triple-digit growth. And eventually, we get a share price close to $101, and this is actually quite in line with analyst estimates along with a few other investors that I've spoken to. And so that $50 price target that was set is something worth noting for sure. And years down the line, if you were to buy into this company right now at a share price of $23.87 Canadian, you are potentially looking to triple your money with the most conservative assumptions, so not bad at all, I would say. Now, I know there are many different ways of score investors, and those of you who bought in a little higher and are getting a little nervous, I'm going to tell you that it's never ideal to be down when you're investing, of course, but there are a lot of catalysts coming. The company's revenue is expected to grow 10 times next year, and so there is a lot of stuff to look forward to. And so that is all for this one, guys. If you enjoyed the video, hit the thumbs up and subscribe button. I will see you soon.